Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, October 2nd. Oil, gold, US Treasuries and the US dollar are up on the back of mounting geopolitical tensions in the Middle East and risky assets are under pressure. Now, the latest economic data, on the other hand, suggests that the euro area's inflation is slowing below the European Central Bank's 2% target, but the US data is mixed. So tune in. We have a lot to cover today. So yesterday was not a great day in terms of news and events. First, the US East and Gulf ports went on a strike as it was expected, a strike that is estimated to impact about half of the US imports. That will obviously cause supply disruptions and increase the price pressures on these goods before November's presidential elections in the US. But we know from the very beginning that there won't be a quick fix or a quick end to the negotiations because simply the Biden administration is not really willing to intervene in the dispute. Second, the geopolitical tensions in the Middle East only got worse yesterday after Iran has reportedly fired about 200 missiles on Israel as Israel now attacks Hezbollah on the Lebanese soil. Israel said, of course, that it will retaliate. So the situation there is getting messy, and the involvement of Iran in this mess could in fact lead to a wider and a more serious conflict across the region, and that would threaten oil supply. So this is why the barrel of US crude actually gained more than 3.5% at yesterday's trading session, but fell short of clearing offers above the $72 per barrel level, which is near a major Fibonacci retracement, the 38.2% retracement on July to September retreat in oil prices, and that should distinguish between the actual bearish trend in WTI and a medium-term bullish reversal. Now, looking back, it's been almost a year since the war in Gaza began. The first month of this war pushed oil prices higher, yet the conflict had little sustainable impact beyond April this year, when traders started giving more weight to the slowing Chinese and world economy than all the supply disruptions, considering that the world is fed enough oil from the Middle East and elsewhere to just worry about the Middle East oil disruptions. But if Iran, which produces around 3 million barrels per day of crude oil, gets seriously involved in this Middle East conflict, we could eventually see the price of a barrel remain under a decent positive pressure for the weeks and months to come. But in fine, we know that the geopolitical tensions have a limited impact in the medium to long run on price trends, and the gains on the back of these geopolitical tensions should be given back with de-escalation and or as the markets and traders get used to the headlines and divert their focus to something else. So voila, it is in this tense and uncertain geopolitical and macroeconomic setup that OPEC Plus leaders will be announcing their latest policy decision this week. Now, the leaders are not expected to make any changes to their previous stance on their oil production. The cartel will probably start loosening its production restrictions in December this year. And also remember that the latest report suggests that Saudi Arabia will be seeking a wider market share rather than higher oil prices moving forward simply because all of the recent production cuts that the country unilaterally shouldered didn't really lead to a better price environment. So it is maybe just time to change this strategy for Saudi Arabia. As such, in the short run, the levels to watch is $72.85 per barrel level for WTI and $78 per barrel level for Brent crude. Rallies above these levels will be tactical opportunities to benefit from the geopolitical tensions of the moment, but limited escalation or de-escalation should keep the prices of oil below these cited levels, and that's due to the prospects of higher supply from the beginning of next year and gloomy economic outlook. Again, near $73 per barrel level for WTI and near $78 per barrel level for Brent. The only thing that could sustainably reverse this trend is China, and the improvement there is yet to be seen despite all the stimulus measures that have been announced in China lately. Now, the mounting tensions of the Middle East sent a wave of worry and risk off across the global markets at yesterday's trading session. Besides crude oil, safe haven assets, including the US Treasuries, gold, and the US dollar gained as well. So gold remains bid near its all-time high levels this morning, while the US 10-year yield tested the 3.70% level to the downside. The US dollar index, on the other hand, jumped, and the S&P 500 retreated nearly 1% yesterday on the back of the risk-off investors that were retreating from the market. The VIX index spiked past 20. Technology and cryptocurrencies were the most hardly hit, mind you. Now, there is no direct reason for that besides the sharp decline that we see in investors' risk appetite. But no, that Nasdaq 100 dropped nearly 1.5% yesterday, while Bitcoin tested the $60,000 support to the downside. And economic data couldn't cheer up the risk takers. The data released yesterday in the US was indeed quite mixed. The JOLTS data actually showed a surprise jump in US job openings in August, but the ISM data told a completely different story for September, because the ISM figures suggested that the contraction in the US manufacturing, it didn't really improve in September. Prices slipped to the contraction territory, and employment deteriorated faster than expected by analysts. And due today, the ADP report is expected to print 124,000 new private job additions in the US last month. That's a bit higher than the 99,000 printed a month earlier, but still lower than the past 12 months average. And activity on Fed funds futures currently assesses about 36% chance for a 50 basis point cut in the FOMC's November meeting, because, the Fed President Jerome Powell told investors earlier this week that he sees 225 basis point cuts for the remainder of the year rather than another jumbo rate cut. But we know that any weakness in the US jobs report this week, especially on Friday's numbers, could flip that probability back in favor of a jumbo rate cut. When the markets and investors want something from the Federal Reserve, they generally get it. Now, I still believe that the US dollar should recover a little bit more to reflect more balanced Fed expectations, and a sufficiently strong jobs data this week could eventually make that happen, simply because elsewhere, some other geographies in the world need the interest rate cuts more than the US does, as I always say, and one of them is obviously the Eurozone. So in the Eurozone, the September update to the Euro area's CPI data suggested that inflation in the Eurozone sank to 1.8% level last month. So that's below the European Central Bank's 2% monetary policy target, and a strongly flashing green light for the European Central Bank to deliver another 25 basis point cut in its October meeting. So the Eurodollar fell to 110.45 level at yesterday's trading session and remains under pressure this morning again in Asia. The pair has now cleared the minor 23.6% support on April to September rally. Trend and momentum indicators remain comfortably negative, and the RSI index doesn't really warn of oversold conditions in the Eurodollar just yet. Therefore, if we don't see a big surprise in the US jobs data, especially a negative surprise, the Eurodollar should continue to extend losses toward the 110 psychological mark and to 109.80, which is the major 38.2% Fibonacci retracement that should distinguish between the actual positive trend in the Eurodollar and a medium-term bearish reversal. So this is all for today, guys. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.